Welcome to the Egan Community Center. Great venue. We were excited to have it here, and I want to thank them for making this available to us. I'm Bob Kincade. I'm the president of Stonebridge Capital Advisors. We're going to have what we refer to as hopefully a roundtable. We're going to have a couple of introductions relative to our focus on the economy as well as the markets. And what we'd really like to accomplish today with all of you are some questions and answers, so we can get to the heart of what it is that you're thinking about during this time frame in the market and see if we can answer those questions. I'd also like to thank the people who are here on the webinar. You may have some burning questions that you'd like to ask. If you do, please send them to us via email, and we will make sure to do our best to get that back to you within 24 hours. If it's a more complicated question, it might take a little longer than that. But anyway, thank you so much. Welcome. I'm going to ask Dan Laufenberg to come up and give us his perspectives on the economy.
Oh, thank you, Bob. Thank you, Bob.
We presume it's not going to take more than an hour and a half, right, Dan?
Yes.
Okay.
I'll try to keep it brief. I was going to start with a joke, but I decided I better not. So I'll start with the economy. The economy seems to be doing pretty well. Maybe that's the joke. It's doing pretty well. And in fact, we're growing about 2.5%, which is a reasonable number for an economy that's this late in the business cycle. And given that this economy can probably grow potentially only about 2%. So a 2.5% growth rate is quite good for this stage of the business cycle. And where are we getting that growth? Well, primarily it's the consumer, once again, that's driving the result. And we think it's the consumer that's going to continue to drive the result over the next year. For example, the consumer represents roughly 70% of the economy. And so if the consumer is doing well, the economy should do reasonably well also. And the consumer did very well in the fourth quarter of 2017. Real personal consumption expenditures. This is the value of consumer spending adjusted for inflation was up 3.8%. That's one of the strongest quarters that we've had from the consumer in a very long time. What's interesting is that the consumer was spending at that pace despite the fact that real disposable income, the money they have to spend, was not growing nearly that fast. In fact, real disposable income was growing about 2%. And so you basically had a very strong consumer in the fourth quarter without that really uptick in the real disposable income that you would normally expect under those circumstances. So what does that mean? It means that the consumer was actually saving less. So the consumer was out there spending, and they were saving less. So they were dis-saving, in a sense, right? Well, they weren't dis-saving because it wasn't negative, but the saving rate slowed down. So they had a pretty significant drop in the rate of saving during that period. Now, how do consumers save? Well, according to the government, when they put together this statistic, consumers save. The definition of saving is, well, whatever they spend minus whatever their income minus whatever they spend, that's their saving, right? That's saving. It's just the residual. They don't really measure saving. It's derived from their two measures of spending and income. So their measure of saving is only as good as their measure of income and spending. I just want to warn you, those numbers are going to be revised, and they'll probably be revised quite a bit over the next 3 years. But the point is that the consumer looked like they were spending more than they had in income, or spending more in terms of income. Their growth was stronger than their income growth, which meant that they were saving less. Another way for consumers to dis-save or take less, reduce their saving is by borrowing more money. So if you're borrowing money, you're using that money to spend, it's not income, it's borrowed money. So you're effectively borrowing from your future income. And so that's another form of reducing saving. So how do you reduce saving? You actually either you don't have as much income as you had, or you actually start borrowing. And that's another thing that consumers have been doing more of lately, is that they've actually picked up on the borrowing, which is another trait that consumers typically go through at this stage of the business cycle. But all that being said, it looks like the consumer is still going to do pretty well. Consumer confidence is quite high still. It looks like we still have job growth. It looks like wages are starting to show some signs of improving. So there is some improvement in income. So consumers are certainly going to start to feel, if they don't already, they're going to start feeling better. They're going to feel wealthier. And so that's going to help stimulate some spending as well. So we're pretty confident that consumers are going to continue to spend, maybe not at that 3.8% pace that we had in the fourth quarter, but certainly at a pace strong enough that's going to allow the economy to grow somewhere around potential of roughly 2%. So if we have 2% growth in 2018 over the 4 quarters of this year, we're probably going to be growing roughly at trend, maybe slightly better than trend, because trend is probably, as I said earlier, probably the potential is probably somewhere around 2, maybe a little less. So what that means is that the unemployment rate is probably going to continue to fall. The unemployment rate at 4.1% is probably going to fall below 4% by the end of this year. Now, that's not a significant drop. That's not the kind of drop that we've been experiencing over the last few years. But you have to remember, we're getting closer and closer to full employment, so it's going to be harder and harder to find people to employ. So the unemployment rate is already very, very low. How much lower can it go? It can go lower. We think it will, but it's probably not going to go dramatically lower from here. Because full employment, most economists would argue that full employment is if the unemployment rate gets around around 5 to 5.5%, somewhere in that neighborhood. We're at 4.1. We are already, by most definitions, at full employment or beyond full employment. So it's going to be harder and harder for people to find people to employ. And by the way, I don't know if you noticed in the local paper here this week, but we had an article about how businesses now are starting to think about ways to encourage older employees to stay employed longer, not to retire as early as they might have planned. So they're creating some incentives now for people to stay on the job longer. Because one of the reasons why you don't have the labor force growth that you would normally expect is because we have a lot of boomers that are retiring. And the boomers are retiring at a pace almost as fast as the new people are coming on into the market, into the labor market. And so you don't have much labor force growth, right? You increase labor by either hiring people or working more hours. And that's sort of that's the only way you do it, or make them more productive. That's another way. You can increase output by making them more productive. And we're having a hard time doing that at the same rate that we did in the 1990s. So the potential for the economy is again around 2%, maybe a little less, but and so we should be pretty happy with something around that in terms of growth. And I think that's what we're going to get. Now, are we going to continue to grow at 2% forever? Unfortunately not. Because we are at beyond full employment, because wages are probably going to continue to go up, because prices are probably going to follow suit. Here's the story. If you've got very low unemployment, it's going to mean that if you have a labor-intensive operation, you require a lot of workers to produce the good or service that you're providing, you're going to have to pay higher wages. Your costs are going to go up. If your costs are going to go up, you're going to have to find a way to cover that. Either you reduce your profits or you increase your prices. Businesses, for the most part, are going to be very reluctant to reduce profits. They're going to try to maintain those profit margins, and they'll do that by raising their prices. And if you look at the inflation rate that we had in the fourth quarter of last year, a lot of the consumer price inflation that we had came from the service sector. It was service inflation. That's where we expect this inflation to come from. We expect prices to adjust up, especially in the labor-intensive areas, not so much in the goods areas. For example, to give you an example, the government measures inflation. The Bureau of Labor Statistics provides us with a consumer price index. You've heard of the CPI, Consumer Price Index, a great index. It's probably, in my view, it's probably the best measure of inflation that we have, but it's far from perfect. What does it really measure? It probably measures the utility that you get from a product more than the price you pay. For example, if you go and look at the statistics that the Bureau of Labor Statistics provides with respect to new car prices, new cars, since 1996, December of 1996, according to the Bureau of Labor Statistics, according to the Consumer Price Index, the new car prices have gone up 1.4% over that whole entire period. 1.4% over, a 22-year period? Right? If you look at what the average price of a car was in the fourth quarter of last year versus the average price of a car at the end of 1996, the price has doubled. The average price of a car has gone up 100%. It's doubled. But according to the Bureau of Labor Statistics, it's only gone up 1.4%. How is that possible? Well, because according to the Bureau of Labor Statistics, when you buy a car, what does it do for you? What does it provide you? It provides you a means to get from A to B and back, right? That's what a vehicle does. It gets you from A to B. That's what it does. So if you buy an SUV instead of a sedan, or you buy a car or vehicle that has a GPS and you have, all the fancy gadgets that you have, power steering, all this stuff, you're paying for quality improvement. You're not paying a higher price. You're paying for quality improvement. So it's quality improvement that reflects that big increase rather than the price inflation. So what the Bureau of Labor Statistics does is it takes that CPI measure, that price measure, and it subtracts any price increases due to quality improvement. And that's what the price it reports. Think about another example, although I don't have the exact dates that give you, but another example would be healthcare. One of the things that has happened to medical care services that you've seen an actual much smaller price increase, or maybe in some cases even a price decline in medical care, even though you're not paying a lower price. And the reason is that, for example, if you go have a minor surgery, how many surgeries now are performed as an outpatient? You don't have to go to a hospital. That's a cost saving. That's an efficiency. That's a quality improvement. How many times have you had surgery and you're up and about in 2 days rather than the normal 2 weeks that you used to have back in the day? That's a quality improvement. So even though you're paying maybe a higher price for that health care, according to the Bureau of Labor Statistics, it's not as much of an increase as you think because it's quality that you're buying, more quality. So the point here is that if you're looking for the CPI to provide you with a measure of inflation that's going to suggest that inflation is going through the roof like it did back in the 1970s, it's not going to happen because they don't measure inflation the same way now as they did then. Before 1995, the government basically didn't do much quality adjustment to prices. They basically reported the price. They did some, but it was very minimal. Since 1995, they adjust almost everything for quality now. The problem is they tend to adjust for quality improvements, but they don't for the other direction, right? For example, in the old days when you had somebody come out and pump your gas for you at the gas station, right? Well, now you pump it yourself. The price has gone up. Now, should the price at the pump reflect the fact that now you have to pump your own gas? Yes, it should. That's not a quality improvement. I'm doing more of the work now. I'm providing part of the service, pumping my own gas. Well, anyhow, you get the point. The point is that if you're expecting inflation, the CPI, to show you the kind of inflation that we had in the 1970s, it's not going to happen. But it's going to be enough inflation, in my view, that at some point you're going to have a problem. And the problem is that you'll reach that point where the consumer now is faced with prices going up, whether it's being measured properly by the CPI or not. Prices are going up faster than their wages. And they're going to have a difficult time maintaining their spending in real terms at that same level. And when consumers run into that situation where they can no longer maintain that spending, they have to cut back, that's when things slow down. And we think that at some point next year, not this year, we think we're okay this year, but we think sometime next year you're going to reach a point where inflation is going to be going up enough where consumers are going to feel the pinch and they're going to start to pull back. And I think that they're going to pull back enough that it's actually going to result in a recession. It'll be a consumer-led, inflation-induced recession. And I think that's what's coming. It's not going to be I don't think it's going to be as severe as the last one in terms of the economy, simply because housing isn't going to be the reason. You think about it, housing is the most frequent asset that households own. A lot of people, their only asset is their house. Not this crowd, because you're Stonebridge Capital Advisor clients or potential clients, so you have something other than a house. But there's a lot of people that the only thing that they have is their house, and when the value of the house goes down, they're in trouble, especially if they borrowed on that equity in that house. And so that puts a lot of strain on the economy. It puts a lot of pressure. This time, it's not going to be housing that's going to cause it. Housing will suffer because it's a residual. Housing always has a little bit of a hiccup when you have a recession because people don't have the same spending power they had before, so they don't buy houses to the same extent. But it's not going to be like last time. And as a result, it's probably not going to be as severe as last time, although it will be painful. I like to think that but it doesn't last forever. Good news. What is the average length of recessions in the United States since World War II? 3 months. Average length is 3 months. The last one was an anomaly. The last one was a lot longer than that, which was unusual. 3 months. Three quarters, sorry. 3 quarters, so 9 months, right, is the average length of a recession. It's 3 quarters, sorry. So this is the next one going to be a forever recession? Probably not. But it will be a recession. It will be painful, but it's going to be over at some point. It will end. And that's what you have to keep in mind. And we don't think it's going to start this year. We think it's probably next year. That's our best guess. But we're getting close. Everything indicates that we're getting close. How long has this expansion been going on? This expansion has been, we're in, the 9th year? Average length of expansion is around 4.5, 5 years. This has been a long expansion. Now, expansions don't die of old age. They generally are killed somehow by a shock. They're shocked to death. And what is the shock going to be? I think the shock is going to be that inflation becomes more of an issue than people think. Not the 1970s kind of inflation, but enough inflation to put some pressure on consumers that they're not going to be able to spend like they have been. And that's the key. It's not just energy. Inflation is when prices across the board go up. It's not just when one price goes up. If one price goes up, that's a relative price change. You just buy less of that if you can, right? And you maybe buy more of something else that's cheaper. But if all prices are going up, if you truly have inflation, if all prices are going up, then there's no place to hide. There's no place to go. You're really caught with less purchasing power, and you're going to cut back. Now, is business spending going to save us? Because we cut corporate taxes, and so everybody is expecting business spending to really pick up as a result. Probably will help in the very short term, but businesses only invest not because they have a tax advantage to do so. They generally invest only if they know they're going to sell the product that they're producing. So you don't make anything unless you know you're going to sell it. And if the consumers are starting to feel a little stretched, it's going to be harder and harder for businesses to sell that product. So why would you invest? Now, you might invest to make your business more productive. I've heard that one. Businesses are not going to be able to invest more money to make their businesses more productive. Well, you want to be more productive? Why? Well, you want to be more productive because you have more demand for the product, so you can produce, with the existing labor force, you can produce more goods. Well, why would I do that if I don't have anybody to sell it to? Right? So I don't know if I do that. Another thing is that we are now already the most productive economy in the world. We have to invest just to maintain that position. We have to make investments all the time. We have to renew our capital stock so that our labor force is more productive. And now when you got all these young people coming in, newer people that are not as experienced as the old people, they give old people a bad name because we're not as tech savvy as the younger people. I admit I'm not. My 12-year-old, now soon to be 13-year-old granddaughter can run circles around me. My 19-year-old grandson has already gone way past me. We can't even talk about this stuff anymore because I don't understand them, right? But the point is that they're much more tech savvy. So am I going to, but I'm going to have to provide them with some equipment because they're not going to be quite as at least early on in the job, they may not be quite as knowledgeable, as skilled, as experienced as I am in the job, right? So they're going to need a little more technology just to do as well as I did. So they can jump in and start running. So we need that. We need to renew that capital stock, and we're going to do that. And we can do that now because corporations now have more wherewithal to invest. They probably will. We'll probably see it in the first half of this year. In the second half, you're probably not going to see as much because they're going to do most of it early on. Think about it. Businesses. If I'm a business and they just reduced my corporate tax cuts, or my corporate taxes, how long are those corporate taxes going to stay low? Any guess? You think they're going to be this low forever? No. I would guess that the next time you have a democratically controlled Congress, you might have a change. So am I going to do this now? Absolutely. I'm going to do as much as I can now, reasonably do now, because I'm not sure how long this is going to last. So, but I don't think I just don't think that there's that kind of opportunity out there for them to do as much as a lot of people are suggesting. They will do some, but it's usually in the first half, and then it's going to start to fade. So we have a first half of the year where the economy is probably growing around that 2.5% to 3% pace, because we can do that with all these other things going on, but we can't sustain that. In the second half, it's going to be around 1.5%, 2%. And then we see something that's going to be a lot slower next year, if not an outright recession. So that's my story. The Fed is going to be raising rates through this. The Fed, I think, is going to do 4 rate hikes, 25 basis points each. I think most people expect 3. I think the Fed said that they expect to do 3. I think they're going to find themselves in a situation where they may have to do more than that, only because I think inflation becomes a bit more of an issue than they would hope. Is the Fed going to cause the next recession? No. It's going to be inflation. In fact, you might say that the Fed isn't going to cause this next recession, but the fact that the Fed didn't act sooner than it has may be the reason why we have the recession. And it wouldn't be maybe not as severe as it would be if the Fed would have acted sooner. As you can guess where I'm coming from. I worked at the Fed for 14 years. I like the Fed to be a little anticipatory. Anticipate what's going to happen. Don't wait until it happens, because if you wait until it happens, it's too late. You got to anticipate a little bit. You got to make the move. The Fed cannot prevent recessions. They cannot prevent the business cycle from occurring. There is no way to legislate away fear and greed. Right? You're going to be greedy when things are going up. You're going to be fearful when things go down. What law can you pass that's going to change that? There is none. What can the Fed do to change that? Well, what the Fed could do, maybe, is don't let it get to the point where everybody is super greedy. End it a little sooner. Take the punch bowl away a little sooner. Don't let the party get so strong. Give me a break. Don't give me the hangover that I deserve. Right? Give me a break.
Do you have a sense of the timing of this, the next recession?
Right now I'm thinking it's sometime early next year, 2019, early. And I think, and again, that's when it starts, and it's probably going to be over by the end of the year. It'll be over by the end of 2019. So, yes?
In this report dated January 8th, you've got the 10-year bill at 2.7.
Right.
At the end of this year, when I left my office, it was at 2.8
Right.
or 9.
Right. It's 2.89, I think.
What are you thinking now?
2.89.
So you think it's going to stay there for the rest of the year?
No, but it'll end the year about there. Yeah, it's 3%. I think is probably roughly where I think it's probably going to end up at the high, because what you end up happening is that if the Fed actually does start raising rates as much as I think, The long end right now is worried about inflation, right? That's why rates are going up. A lot of inflation and some additional Treasury issuance, new issuance. So it's got a little pressure there. But at some point, the market's going to be convinced that the Fed has gone too far. And when the market is convinced that the Fed has gone too far, then long rates start to come down. When long rates start to come down and the Fed is pushing up short rates, that's when you get the inverted yield curve. And then,
Can you kind of give us an idea of where you think the short rates are going to go? So
short rates, I think, are going to go to 3. Okay. Maybe 3 and a quarter, maybe, but 3 probably is the high. And then long rates are going to be slightly lower than that at some point before the end of the year.
And an inverted yield curve typically
Inverted yield curve means that, let's say, the 1 year is higher than the 10-year yield.
And is a precursor to?
Typically, and since 1953, every recession that we've had has been followed by an inverted yield curve. Now, there's been inverted yield curves without a recession. So it's not a sufficient condition, but it's a necessary condition. You've never had a recession without an inverted yield curve. But you've had an inverted yield curve once without a recession. That was in the mid-1960s when, in fact, the National Bureau of Economic Research probably could have called it a recession, but they didn't. But 53, we had a recession without an inverted yield curve. And this is an interesting point, if I may, because it's in the document that the gentleman in the back is reading from. Is an inverted yield curve necessary for this next recession? And I went back to 1953 to see what the conditions were at that time that allowed us to have a recession without an inverted yield curve. And what was happening was that the Fed was unwinding its huge portfolio of government debt that had accumulated during World War II. It was starting to unwind this debt that they accumulated. Well, what did the Fed do during this last economic downturn? They've accumulated a huge amount of debt, $4 trillion of debt that they have on their books that they're now starting to unwind. So what happens? They're sellers. They're not buyers. They're not net buyers of debt anymore. They're net sellers. And when you sell debt, the value of the debt goes down, the yield goes up. Right? So there's putting some upward pressure on yields by being net sellers. Right? You have the U.S. government was issuing tremendous amount of debt to finance the Korean War. At that time, there was a huge amount of debt being issued in 1953. What's happening now? We've got a huge budget deficit that's going to be financed with additional debt. Right? We're going to be issuing a lot of debt here in the next year or two. You had you coming off of a very low inflation period. In the early 50s, you had very low inflation. In fact, you had the Treasury, you had the government actually pegging prices. Remember price controls during World War II? You had price controls. You had very low inflation after that. You had a little spike early on, but it's a very low inflation environment, and you had a very low inflation environment that we're coming off of here. And you had a Fed that was, and the Treasury that basically maintained interest rates at artificially low levels. There were times during the World War II where short rates were negative. Came pretty close this time. So the conditions that we had in the early 1950s aren't too dissimilar from what's going on right now. And so maybe we don't have an inverted yield curve, but it's going to be close. And I still think inverted yield curve is likely, but don't be surprised if you don't get one. And we still get a recession. But we won't know that for a long time after the fact. The National Bureau of Economic Research will tell us we're in a recession. If the recession starts early next year, by early 2020 we'll be told that it was a recession. I just want to warn you, you're not going to know it right away. And it may take a while for me to be proven wrong. Yes! I'm an old man. I may not be around for that. So, anyhow, thank you.
I always get to follow his act, and that's impossible. And as always, he's given me all of about 3 minutes to give you our focus on the markets here. But I'm going to try and summarize that because I do want to make sure we get to your questions and get the rest of the panel up here. So you have a sense of our expectations. I want to give you a little backdrop on Stonebridge for those of you who don't know us. We manage portfolios separately, and we customize every single portfolio that we manage with individual securities based on the client objectives first. So the client objectives lead us to the types of securities and the asset allocation that we're going to provide for them to meet their objectives. Pretty simple concept, we thought it was. That was going away. We said, no. These are the client's portfolios. They're not ours. I mean, we have a perceived notion about where we think things are going, but it's their portfolio, and it's important we manage that way. So when we talk here a little bit about the markets, please keep that in mind, and we'll go back to this a little bit more. So as we look at this situation that we may be facing economically, thank you, Dan, we would agree with him largely. We're at the latter stage of a market cycle, and it's important that we prepare our client portfolios for that latter stage. And oftentimes the question that we get is, well, when do you start that? Well, for all practical purposes, we've been preparing for the next business cycle since 2009 when this market took off, because that's really our job. And it's in the security selection, in the sectors that we're investing our clients' monies, be that fixed income or equities, to assure that they're attaining the kind of returns that they should at that particular stage of the market cycle. It is also with the length of maturities and the types of fixed income securities that we're buying for portfolios to accomplish what they need to, and at that point, what was an interest rate declining scenario. And then, after you've talked to the client, you look at their objectives, you say, okay, what's the asset allocation that's appropriate for me in 2009 as opposed to the asset allocation that may be appropriate for us as we go into 2018 and 2019. So our expectations for the markets overall, and I'll be brief, but there's obviously more detail. Our expectations for the fixed income market, for bonds, or for that matter, income-oriented equities, and I'll talk about what that means a little bit too. For bonds, we've already had an increase in interest rates of close to 1% on the 10-year Treasury. We have already had, it didn't get much notice in this recent market downturn. Everybody's focused on the equity markets. The bond market in that 10-year range or going out further, particularly high-yield bonds, dropped in value anywhere from 8 to 15%. They remain down in value because, as we just stated, the 10-year Treasury today, for at least a brief period of time, hit 2.9%. So bonds have dropped in value already, particularly on that longer end of the yield curve. We expect that to continue. We expect interest rates to rise, albeit perhaps marginally. We might disagree with Dan on this side. We could see the 10-year Treasury go up to about 3.5% from our perspective. So with that in mind, it's been our focus to try to reduce the length of maturities in the portfolios that we have in fixed income. It has been our opinion that it is time to move away from fixed income funds, be they exchange-traded funds or mutual funds that are out a little bit longer in maturity, or are carrying high-yield bonds, because those are the bonds that are going to get hurt the worst when rates rise, and if we have a recession, their credit quality is going to continue to deteriorate. So on the bond side, we've chosen to take a more conservative position for our clients, give them a portfolio that averages roughly 3 years of maturities, maybe 3.5 years, and protect them from those rising interest rates with the intention of having those bonds mature at times when interest rates have risen and they can benefit from reinvesting at a higher interest rate than they originally invested their money. And at that point, perhaps make a decision about whether or not they want to extend their maturities or keep them relatively short. And we'll have to see where we are in the cycle at that stage of the game. So it is a relatively defensive position, but that may not be appropriate for everybody. We have clients that say, you know what, I'm still looking for yield. I want to reach out a little bit longer for that yield. I understand that markets go up and down, and I understand the price of my bond might go up and down. I want you to go up a little longer to pick up an extra 0.5% or 1% in my portfolio. I need that from an income standpoint. Okay, we can work with you on that. But our opinion is this is a good time to be a little bit more defensive. And again, yep, you're going to have a fairly low yield, 2.5% to 3.5%, but it's going to protect you on the downside on the in the bond market. And so that's been our recommendation. Now, as we enter this year on the equity side of the markets, after an absolutely fabulous year of 2016, where the S&P 500 was up around 21%, it's fantastic. This year, our expectation for earnings growth, the earnings that these companies are going to provide going forward, roughly around 13%. That's a fast growth rate. Part of the reason for that growth rate is because of what's happened with the tax laws that will be beneficial, but it's also from what Dan just stated earlier. We have an economy that is doing really well. And when we look at the earnings reports from these companies, particularly over this quarter and the last 2 or 3 quarters, they've been excellent. And the great part about what's happened over the last few quarters is not just earnings growth, because in the past we had reasonable earnings growth, but it was all because the companies were cutting expenses. Now what we're seeing is companies invest, perhaps not as fast as we might want them to, but they are investing. And they're growing their revenues, which is something we've been looking for a long, long time. Now, that's easier for some companies to do than other companies to do, and we recognize that. It's easier for some sectors of the economy to do than other or sectors to do. And we'll talk about that in a second. But our expectation is that, yeah, we're going to have a reasonable earnings growth rate. Unfortunately, it's also our expectation that we think the total return of the market is going to be less than the 13% growth rate. And part of the reason for that is inflation's going to creep into the picture. The valuations today are relatively high. The earnings are around 22 times, which is at the higher end. Forward earnings might be around 17 times relative to the earnings we're seeing, but it's kind of high. And as the bond interest rate yield improves, it creates a competitive market vehicle to that of the equity markets relative to the risk that investors are taking. Investor might say, you know what, if I can get 3.5%, maybe even 4% on a good quality corporate bond, that's half what the S&P 500 provides long term, which is about 8%. Now I've got a competitive vehicle to look at and invest my funds in. And 4%, just, for the heck of it, there's an old theory that if you have an IRA and you're drawing from your IRA after age 70 and a half, and if you keep that draw from your IRA at about 4% on an annual basis, which nobody ever does, but let's just say it averages about 4%, you'll never really draw the principal down on your IRA if it's managed properly. So 4% is a number that people kind of they pay attention to. So we see that potentially happening as we get closer to the end of the year. As we go through the next quarter, the challenge our companies are going to have is to be able to compare favorably to the earnings they provided in last year. So the analysts are all looking at those earnings reports. Oh, gee, they were only up 4% from last year, or only up 5%. That's going to have an impact on the valuation of the market. So what happens in the market on the equity side is what you get is a very, very, very narrowing view of investors in terms of the companies that they want to acquire. And their perspective on it at the latter stage of a market cycle is to be invested in companies that are going to grow faster than the other companies in the market. So on the equity side, when we looked at sector allocation, I talked earlier about the impact on bonds in the market when interest rates rise. There's a similar impact on certain sectors of the equity market that we're already seeing. For instance, utility companies. You could pick a local one, XL, Duke Power, or some of the real estate investment trusts that are traded publicly. They have a yield. People are excited about it. That yield may be around 3 or 4 or 5%. Or you could look at some of these slower growing, well-known companies like General Mills. Could be 3M. sorry. Could be 3M. These companies tend to grow at a very slow rate on the revenue side. It may be a 2 or 3% growth rate. They tend to pay a pretty good dividend yield, but that dividend yield has dropped over the last few years because that price has gone up. So do you want to own a real slow growing company that's paying you 2%, that's going to grow at a rate of maybe 1%, when you can buy a company perhaps like an Amazon that's growing at 15, 20%, pick a number, or Facebook, or Apple? You know, as an investor, you start to say, you know what, I'm going to lean a little bit more towards these growth companies. And that's what we saw in 2016. It was a change from 2015. 2015, value is where people wanted to put their money. And those value stocks with higher dividends moved up faster on a total return basis than growth companies. Returns on value stocks during 2015 was around 15, 16, 17%. Growth in that year was anywhere from a negative return to 4%. So the market is rotating. Investors are rotating. In 2016, they said, okay, here we go. We have an opportunity for growth. We're going to take advantage of it. So growth stocks were up anywhere from 25 to 30%. Dividend income stocks ranged anywhere from 8% to maybe 14%, or value stocks. So you got a rotation there. We expect that rotation is going to stay in place, and we are looking at portfolios right now in preparation for this next stage of the market cycle, both from the standpoint of what to invest in on the equity and fixed income side. So on the equity side, we're going to focus a bit more on those companies that are going to provide us one of two things, or hopefully both: growing revenues, growing earnings, growing cash flows, and yes, growing dividends. And we're seeing more of that with these earnings reports. People are popping their dividend yield up. We like dividend growth stocks because we believe that's going to provide the long-term income that some of our income clients are searching for. The growing revenues and earnings of many companies on the growth side of things, for perhaps investors that are more aggressive, that's where we want to put our focus. Now, Pat's giving me the high sign. Hey, he got an hour and a half. I didn't know. Asset allocation. I mentioned earlier that we're not asset allocators. In other words, we're not shifting from cash to bonds to stock to cash to bonds to stocks at every given moment. The objectives for asset allocations are what drive what we do with portfolios. So we're not suggesting massive asset allocation changes on a regular basis, but we do sit down with our clients when we get near the top of a market cycle like this and say, now isn't such a bad time for us to take a look at your portfolio to see if it's going to do what you expect it to do in the next 2 to 3 years if we have a recession. If the market drops 25, 30, 40%, how are you going to handle that? Now, we have some perhaps younger, more aggressive investors that say, I don't care. I've been in stocks all my life. I know they go down, they go back up. Keep me in stocks. That's fine. Our opinion is, you're right. It is longer term going to do well for you, but it would be nice to have some cash on the sidelines for that drop so we have money to reinvest when prices are lower. So we're advocating a concept of saying, hey, let's take a look at perhaps providing some liquidity, either in short-term bonds or possibly in money market funds for that more aggressive investor. Now, we have a lot of clients who went through 2008. They came into us after that and struggled with a very deep recession, lost a fair amount of money in the market, who are now 70, 80, even in their 90s. And during this time frame, they've recouped a great amount of what they lost, plus more, and are very successful and set with their portfolios going forward. They'll provide the kind of income that they're looking for. For those clients that can't afford to take that kind of risk again, with another 30 or 40% decline in value in the equity markets, we're suggesting that they consider bringing their asset allocations back out of equities and into fixed income and cash, so that we're protecting them on the downside particularly, but also, just like the more aggressive investor, giving them that cash or bonds that as we go through this recession, and if Dan's correct, it's fairly quick, we have an opportunity to reinvest. So that's our perspective on things. There's a lot of history on it. I'm going to bring up some more intelligent people to talk about that. So Steve, Heidi, Dan, and Ron, who is our moderator, I'll let you come on up here and ask us some questions. We're happy to address anything that you have on your mind.
Oh, thank you.
Well, hello, everybody. Thanks for being here. I just want to make sure that we're on record. I've been now at Stonebridge for 10 years, going on 11.
It seems like 50.
And I've been in the bond market my entire life. And finally, Bob has come around to decide that bonds are a good thing to be in. And I just want to congratulate you on that, because I think it's a good call at this
I learned
point
it
in
all
time.
from you, Ron.
Yes,
Thank you.
yes.
Yeah.
So what we're going to do for the rest of our time here is we're going to open it up to some questions, and we're going to open it up to any kind of a question that you would like to ask. And I want to make sure that we get the microphone, and I think Patrick or Lori has the mic back there. So raise your hand and we'll get you the microphone. But I'm going to start it off with some thoughts here and some questions. First of all, we've talked about interest rates, Dan, and we've talked a little bit about bonds, obviously, but as it relates to interest rates, you had thought maybe 3% on the long end, maybe 3.25%. We've known over a long period of time, and you even mentioned it, that the market sometimes reacts more violently, if you will, than the Fed. It overreacts, right? So if we have interest rates rising and the market feels the Fed is behind the curve, could we get a 4% 10-year U.S. Treasury?
Absolutely. You could get a 4%. Clearly, if the market perceives the Fed to be behind the curve, that inflation is sort of getting out of control, then the long rate is going to penalize the Fed by pushing rates higher. The bond vigilantes will be out in force, making sure that rates are moving higher. So yes, it could happen. That's not my forecast, but it certainly could happen.
Anybody out in the audience have a question on interest rates? All right, then let's move on to economic recoveries, economic and business cycles, and presidencies. So the question is, can any president claim credit for what happens, whether it be 13 months after they were elected or at any period of time? What does the president have to do with economic policy and economic recoveries, in your opinion, Dan?
I've written a piece about this, so if anybody's interested, I'd be more than happy to share it with you. The evidence suggests that presidents have very little impact on the economy during their term. Slight impact maybe, but not much. And it may be more of a lagged effect than anything. It's not clear. One of the things that I pointed out in my piece, and I can't remember the exact number, but it's more important for presidents, the perception about how a president does with regard to the economy. It's more important when the president gets elected in the business cycle than it is what the president does to affect the business cycle. For example, if I'm running for president, I want to get elected near the end of a recession. I want to be that president because I know I'm going to be in office at least 4 years and I'm not going to have another recession in that 4-year period. And in fact, we're probably going to have a recovery and I can take all the credit for the recovery, right? And I can blame the recession on the last guy. Or if I have a recession early on in my first term, I can blame the recession on the last guy and then take credit for the recovery before I have to run for re-election. So it's more important for the president, the people's perception of what the president can do for the economy is when the president is elected in the business cycle than the actual impact on the business cycle.
Can I start up?
Just one of my things that I wrote, and I don't remember the exact number, but since 1946, I think it was, I think all but one of the recessions that we had since 1946, a Republican was in the White House. Now, that doesn't mean the Republican caused the recession. It just so happened that they were unlucky enough to be there when it happened. The only one recession that we had with a Democrat was Jimmy Carter.
Interesting.
And the only thing that I would add to that is administrations can impact tax and regulatory policy with a lag. With a lag. So throw out the politics, just run the numbers. Over the last 8 years under the past president, the U.S. economy grew at 1.9%, inflation ran 1.7, so nominal growth ran about 3.6. During that period of time, the 10-year average about 2.2%. So about 140 basis points underneath where nominal GDP growth was. The reason interest rates are moving up now is because we've had 3 straight quarters of near 3% GDP. The market thinks GDP growth is going to sustain there with a little bit higher inflation, so nominal growth is going to run maybe close to 4.5.
For a short time.
For a short time. And the market doesn't know that right now. Doesn't know. But the 10-year has to price against it.
But you could argue that the 3% growth that we had this year had nothing to do with the current administration.
Wholeheartedly agree with that.
You don't know who caused it. It just happened.
But if we're going to run nominal growth at 4.5 for several quarters, which we have been doing, and we may extend that, well, if you want to keep the 140 basis point differential between 4.5 nominal growth, you'd think the 10-year might have to run to 3.10, 3.15 in that area. The question is whether it sustains there.
No, I wanted, I just wanted you to.
Just brief introduction to the guy that was just speaking.
Yeah, I was going to do
Steve
that.
Roorda is our senior research analyst and portfolio manager, and has done this for quite a while.
37 years.
Yeah, okay. Heidi,
So-
did you want to say something, or you? Oh, okay.
We'll talk a little bit about the stock market and the recent volatility that's gone on since January 26th. Steve, what's your perspective on the cause of the market volatility and how long you think this volatility is going to go on?
So we hadn't had a 3% correction in 15 months, so we were due for a correction. And the market ripped 7% in the month of January. And the bond market had been ripping higher, and the stock market had been ignoring it. And then one day, the stock market didn't ignore it. The VIX spiked, and there's a lot of structured products in the market that bet on an inverse VIX play, and that the VIX is just volatility within the options market between put and call options. And so what happened is you had a lot of people betting that volatility would remain very dampened in the market, which it had been for 15 months, and you have a lot of these structured products, not the products that you read about and CNBC talks about that you can buy through Fidelity or other brokers. I'm talking about structured products that Goldman Sachs and Morgan Stanley run for clients of the firms I used to work for that, again, that are into the hundreds and 200 billions of dollars, not these $3 billion inverse VIX products that you've been reading about or hearing about. So when those things started to unwind, the VIX spikes, those people have to cover their positions. They're levered against low vol spikes, and all of a sudden the market just has a massive sell-off in a very, very, very short period of time. I think we're through most of that massive volatility, but I also expect the market to remain very volatile versus the past 15 months as we go forward over the next several months and quarters as we start to normalize the interest rate and inflation markets.
All right. Let's go back to bonds. Heidi, let's talk a little bit about the asset allocation within bonds. And Bob talked a little bit about the Stonebridge strategy. But what is the value of owning individual bonds over bond funds?
We've talked about that for years. that we prefer to buy individual bonds. You can control the cash flows, you can control the maturity structure, you can control the credits in the bond portfolio and the sectors you buy. Especially now in a rising interest rate environment that Bob alluded to, we want to avoid mutual funds because as interest rates rise, the market value drops. So what we saw in 2008 was an extreme example, but you saw market values falling in bond funds and people liquidating the bond funds. Therefore, the bond funds have to liquidate the bonds, which makes the bonds worth less. And it was just a self-fulfilling prophecy that bond funds lost so much money. We do have a lot of clients that survived that. We own the individual bonds. You earn your coupon, you wait for it to mature, you get your par back. So that's the main differential. We have had some success. I know Bob said we're avoiding ETFs, but he meant longer maturity or longer duration ETFs. We have found success for a small bond allocation. If you don't have enough money to buy individual bonds, you can get the diversification at a much more efficient fee standpoint by buying maturity dated ETFs. Those are baskets of bonds that all mature within a few month time span. So for example, you could buy a 2022 municipal ETF. So your client is, or the client is getting a basket, a fully diversified basket of munis, yet with a maturity, just like owning an individual bond.
Good. Have we raised any questions yet from any of you? Okay, I'm going to keep going on the questions that I have listed here then. Bob, you kind of gave your views, so I'm going to kind of defer here to, if I can, to Steve. Steve, Bob talked about the FANG stocks and the move to growth in the year of 2017, and everybody wanted to play with the Facebook and the Amazon and the Apples and the Netflix and the Googles, et cetera. But the one elephant in that market has been Amazon. How does a company that we all know, how powerful is that company within the context of the market?
So I love the name that a Wall Street analyst gave Amazon the other day, called it the Death Star. And it is the Death Star in a sense that if you simplify what Amazon is, think of department stores back in the 1920s and 1930s. What do retailers bring to the equation? They bring price, assortment, service, and convenience. Amazon just does it on a massive scale. So if you walk into a Target store, you'll find 75,000 SKUs, stock keeping units.
SKUs meaning?
SKUs, individual units. Walmart might have about 135. Walmart also carries about 65 million items on their website. Amazon carries 355 million items on their website. So, and we also know that they're willing to invest against the curve and run a 3 to 5% operating profit margin business in their retail business on a global basis. So if they're offering you the best price, the best assortment, and they're offering you convenience, right? Ship 24 hours, Prime. Why would you shop anywhere else? Or maybe the question is, would you spend less at your existing retail stores that you shop versus Amazon? And of course the answer is yes, I'll spend more dollars on Amazon. So as a scale, so much faster than the competitors, and with assets that are already better than their competitors, the Death Star will continue to take out other retailers over the next decade. And there's really nothing to stop it. From a valuation perspective, you can look at Walmart and say, Amazon, say it's trading at 100 times earnings. The reality with Amazon, though, is they invest so much against the curve. If the revenues are growing 40% and they spend 39%, they can still grow their profits at a very rapid rate. What happens if Amazon in 1 year decided to spend at a 10% rate? Meaning they opened less DCs, they brought less categories online, they chose to not enter 2 or 3 countries that they have lost leaders in the first initial years. all of a sudden Amazon's profits would explode. So Amazon is a very, very important ecosystem, both for retail. It already is for web serving, and they're already moving to $25 billion in revenues there. They're already generating 50% plus operating profit margins in that business. And the question now will be whether they start to make some moves in healthcare or supply chain logistics. FedEx might feel it, UPS might feel it. Will other parts of healthcare start to feel it? We don't know, but you better watch out for what they do next, and which is why Amazon trades at the valuation it does, and I think it's appropriate.
Not the only company out there, and if you can maybe comment a little bit as well. China has a company that's doing something similar and perhaps even on a grander scale.
Yeah, Alibaba.
Alibaba.
Yeah. Likewise. I think the other important thing with, as we mentioned earlier, with growth and tech is that if you all remember in the 99-2000 downturn, tech got blown up. And stocks were traded at much higher valuations. But remember one important thing. In that period of time, the tech companies then, except for a few like Microsoft and others, were cyclical growth tech. Amazon, Netflix, Facebook, Google, I don't see a lot of cyclicality there. I just see secular growth, growth, growth. So it's another reason why tech and growth companies within tech are doing so much better at this point in time in the economic cycle than we saw in the 99-2000 downturn.
Dan, let's talk about the U.S. dollar. The U.S. dollar is down, I think it's 14% so far this year.
Yes.
What impact does that have on companies that are domiciled obviously in the United States and their products overseas and vice versa, and how is that going to affect the global economies?
Weaker dollar generally makes our goods less expensive to the rest of the world, so it should encourage people to buy from us. A weaker dollar also is inflationary because it means that imports now are higher priced, and so it does add to the inflation story because now goods aren't as cheap coming in from the rest of the world as they would be otherwise. So it takes more dollars to buy a yen, it takes more dollars to buy a euro. So it just means that it's more expensive for U.S. Importers, and we import a lot of goods. If you think about the U.S. consumer, nearly what, 40% or 50% of all the goods that consumers buy are imported. We do not produce a lot of consumer goods in the United States. Well, we produce a lot of them, but we don't produce as many as we used to. And in terms of exports, we're primarily a capital goods exporter more so than a consumer product exporter. So, but the impact it has on the economy is primarily higher inflation, stronger demand overseas for our products.
So we've talked about a little bit about the bond market. We've talked about the stock market. We've talked about specific companies like an Amazon. How do we look at different sectors in the market? And Steve, you and I talked about that earlier today. Whether it be the industrial sector, the consumer discretionary sector. When we're looking at companies to buy for client portfolios, give them a sense of what we look at within a sector.
So this is my first Stonebridge presentation, but I'm sure people have stood up here on the podium before and said things like, well, we want to invest with managements that have a track record of success, companies that have a culture of winning, because managements and cultures win, not companies. Companies don't run themselves. Companies that have number one or number two share positions in their major segments, stable to improving margins, return on capital, good balance sheets with solid cash flow so they can invest in their businesses, because the companies that innovate basically set the rules of the game, and so that's what we're seeing. But what I wanted to point out today, which is sort of interesting and maybe we haven't talked about enough, is if you looked at the industrial sector over the last, and you can do this across other sectors of the market, the industrial sector in the last 52 weeks is up about 15.5%. It's basically slightly underperformed the S&P 500. And if you owned a index fund that diversified across the industrial space, you'd get industrial performance of about 15%. But if you were a stock selector and you made certain subsector allocations within industrials, your performance would be substantially better. And just to point out a few things. So within the industrial space, in the last 12 months, the Aerospace and Defense Group, which is made up of Boeing, L3, Raytheon, names that we have in our model portfolio and names that we've liked for a period of time, are up 47%. The industrial sector is up 15%. The airlines are flat, 0%. Electrical equipment, industrial conglomerates, electrical equipment companies are up about 14%. Industrial conglomerates, which GE is in, down 14%. Machinery companies like Caterpillar and Deere make up the machinery sector. It's up 30%. The point being, as an analyst who looks at companies all the time, you can have all these attributes that you would like in a company or a sector, but it's really at the subsector level and at the company level where you win or you lose. And that's where we try to do daily for you versus what you might find in a more passive type of investment across industrials or other parts of the S&P.
So the last question on the stock side of it, and Bob, I've been saving you because of your voice, and
Oh, yeah,
I know
thank
that
you.
you're a little bit under the weather. But you talked earlier about utilities and the income side of the market as it relates to the equity side. Talk a little bit about that, because last year value stocks really underperformed in the market. And we do have a period here of what looks to be rising interest rates. How are we viewing the utility sector and those income-oriented stocks?
Sure. I'll go back to the conversation we had about the bond market, and as rates rise, it tends to hurt the values of bonds. And it's somewhat similar to that of those income-oriented, particularly utility stocks, as Ron's pointed out here. At this stage of the market cycle, they're going to struggle. Their values are going to decrease as interest rates rise because investors have purchased them based on the income yield they're providing. What's happened over the last market cycle is that income yield may have started in 2009 at 7, 8, maybe even 9%. And because people purchased those stocks during the course of this market cycle, the value of the stock has gone up, but that income yield has continued to decline. Now, just as a matter of practice, and I've done this for a few years, I don't want to own a utility stock unless it's paying me at least 5 or 6% in a dividend yield. There's a lot of dividend yield stocks and utilities out there paying yields of 3%, maybe 4%. So from my perspective, with a portfolio that's not going to grow, or a stock that's not going to grow that much in value, I don't want to buy it for a 3% yield. I'd much rather find something else that has a growing dividend yield as opposed to pretty much flat yield. So that's the philosophy on that, and it has remained true through just about every market cycle since I've been doing this since '78. I mean, we're at a point in the cycle where take your gains in utilities, move on to other investments that offer yield to you with better total return opportunities.
Good. Tom, question?
Sure, I actually have two. I don't know if you need the mic or not. Two questions. One, is the stock market results tied to recession results, or are they independent?
I can, you want me to answer that now?
That's question one.
I can answer that. I'm sure there will be other people that would like to chime in as well. Generally, you can have periods where the two are decouple, where the stock market doesn't seem to be reflecting, Wall Street doesn't reflect Main Street, as Steve said earlier. But over the long period of time, it is the market and the economy that tend to move together. So if you're talking about a bull market, usually bull markets exist during economic expansions. If you're talking about a bear markets tend to last during the economic downturns. So there is that correlation.
Okay.
But there will be times when the two can, break away, but for only short periods of time.
And if you've watched CNBC, if you at CNBC, you've seen Larry Kudlow on all the time, and he talks about profits being the mother's milk of the stock market. When profits are growing double digits, usually the stock market is doing very well. When you're in an economic recession, profits are declining, the market's going down.
And we had a 13% correction basically in the last month or so,
Yep.
Steve, on no news or good news, economically.
Okay. And the second question is that, Dan, last time and even today, you had stated that the stock market would go up and down much more severely than historically has been done, as just recently happened. Do you think that people will get used to the swings being so severe and will not react as much? And how long will that take before the new normal gets adjusted to?
I don't know. But I would argue that fear and greed drive the result. And if more people are fearful, then the outcome is probably going to be worse than it would be otherwise. And in the past, I've talked about how things have changed, especially with regard to pension funds. Nowadays, almost all pension money is in 401ks. Individuals have some say about how those 401ks are invested. In the old days, you had defined benefit plans where you were guaranteed a certain annuity every year when you retired, but the money was managed by the company by professional managers. I used to work for a company that managed some of those funds, and when they didn't like the stock market, they would reduce their exposure in the stock market from 60% to 45%. Right? We didn't like stocks, so we're going to reduce our exposure. Still very heavily into bonds, but took out some share of stocks. Individuals, when they're in 401ks and they're making that asset allocation decision, many of them, when they are fearful, go from 100% equities to zero. Now, if you have a lot of people going from 100% to zero, you've got a lot of sellers. And when you're selling, what happens to the price? It goes down if you don't have the buyers on the other end. And so when you have more sellers than buyers, the price is going to go down. And we've had that situation since the mid-1990s, or mid-1980s maybe, when 401ks came into popularity, became very widespread. We've seen an increase in the volatility of the swings up and down during the bear and bull markets.
And I'd add one more thing. That this will be the first stock market cycle end or economic cycle end with ETFs having so much assets in them. So when those assets start to unwind, and if many of you all remember the flash crash of several years ago when ETFs were younger than they are now, when you have a lot of people run for the door, it starts to cause some dislocations on day one. So,
Yeah, make sure you are comfortable, if you're invested in ETFs, with how that ETF is structured. Make sure there are no surprises with leverage, either on the bond side or the equity side. And then they're not using any unusual options within that ETF to enhance the return that otherwise the index might provide you. There's a lot of different ETFs out there. It's also advisable to take a look at the size of the ETF. Say, oh, it's an ETF, it's an index. It's got $25 million in it. Wow. I mean, where did it go in January to what, maybe $13 million? So you don't just assume that it's an ETF, it's an index, it's okay, it's going to perform like an index. They do perform differently, and especially when it's just one push of a button and you sell the entire index or the entire market for that matter. So that's a little bit of a change from what we've seen in the past. Though one thing that we do notice, and we've talked about this a bit, the rotations around the sectors, the volatility. tends to increase as you get to the latter stages of a market cycle. Investors are actively seeking the best opportunity they think is available, and they move rather quickly to it. And so we see that as a lead indicator to prepare ourselves, not panic, just prepare ourselves for what the next stage of the market cycle might be.
So, before we close, and I'm going to turn the floor over to Bob again for the closing, what question did we not ask that you would like to have addressed? Brad?
For Dan, do you see the
Wait till you get the microphone. There we go.
Do you see the Fed unwinding the balance sheet having a dramatic impact over the next 12 to 24 months on inflation or the overall economy?
I'm not sure it'll have much of an impact on the overall economy other than through the interest rate channel. Because the Fed unwinding their portfolio, now they're not going to unwind it all. They're going to be pretty gradual, as they normally are about these things. They're going to unwind it, but you have to remember that the Fed is no longer going to be a net buyer of treasuries. They're going to be a net seller. And just that alone is going to put some upward pressure on interest rates. I don't know how much, because we've never been here before, other than maybe in 1953. Pardon?
Additional supply too because of the deficit.
Right,
Yeah.
right. So they're going to be a net seller at a time when the Treasury is going to be issuing more. And so it's going to be through the interest rate channel that it'll have an impact on the economy. Mortgage rates are going to go up. Loan rates are going to go up. Makes it more difficult for consumers to use that credit they need to continue to spend at their current pace.
So currently, the Fed is not reinvesting $20 billion a month, for those of you that don't know that. And by the fourth quarter of this year, it'll be $50 billion a month. That's the unwind of quantitative easing.
Right.
More
But
referred to
that's-
now as quantitative
But
tightening.
that's from a portfolio of, what, 4 trillion?
4 trillion, exactly. Okay,
Sounds like
Brad,
fun.
did you have a second question? Anybody else? Bob?
Thanks, Ron. Thank you, everybody, for coming to join us today. We're going to stick around a little bit longer. If you'd like to ask some more questions of us, we'll be here for a while. I'd like to thank our web viewers very much for joining us today. Special thanks to Yvette Mullen for putting this together for us. Pat, Lori, Mitch, you guys did a great job. And our sound and video crew, thank you very much for what you've done. Folks, thanks very much. We'll look forward to talking with you some more. Take care.
Good job, Bob.
Thank you.